their information or analyze those information will not be reflected in the price, meaning the market will not become efficient. So this is the paradox of the efficient market hypothesis. So say if the market is efficient, it is worthless to gather and collect or analyze information. In that case, market will again become inefficient. Because if market is efficient, investor will stop gathering news, and the efficient market will break. Now let's move to the financial statement analysis. The important idea here is that we analyze financial statements not to describe the past, but to predict the future. Remember, the accounting is the language of business. So we analyze the past information to predict the future. That's what students often miss. And here you need to understand how the threes connect: the balance sheet and the income statement and the cash flow statement. The balance sheet shows the firm's financial position, and the income statement shows the profitability, and it shows how well the business operated in the last quarter or the last year, say some certain period of time. And the cash flow statement shows the actual cash movement. Simply put, the balance sheet is a snapshot, and the income statement is a movie because it shows how well a business operated in a certain period of time. And the cash flow statement is the reality check on both, because the balance sheet and the income statement can be differ from the real cash flows, because those are accounting based earnings measures. So the cash flow shows the real cash flows, how the business operated with its cash for the certain past period. But those three statements are linked, not separate. For instance, the net income in the income statement affects the retained earnings, which will be reflected in the balance sheet. And it affects the equity, the amount of total equity. And the liquidity is about survival. Can you pay your employees and suppliers tomorrow morning? So this liquidity answers, can the firm survive in the short term? To answer this, we focus on the current ratio, quick ratio, and cash ratio. And from here, the interpretation matters more than formulas. For instance, of course, you have to memorize the formulas and you have to know how to calculate those ratios. But more important thing beyond calculation is the interpretation. Say, what does it suggest if the firm has high liquidity ratios? What does that mean? It means that the firms are safe. But if they have too high liquidity ratios, it may suggest the firm is inefficiently using their assets. They're not investing their assets. They're just holding too much liquidity, too much cash. And efficiency asks, how well does the firm use its assets? For instance, the efficiency ratios tell you if management is lazy? Are they sitting on too much inventory? Are they failing to collect cash from customers? So key ratios here is the receivable turnover or the inventory turnover ratios. The faster the turnover, the better the efficiency. But again, too fast could suggest understocking or aggressive policies. So you have to know what are the turnover ratios, or how to calculate those and how to interpret those ratios. And the operating margin is the purest measure of management. It ignores tax and interest, and it look at the core business engine. And the profitability shows how much earnings profit is generated per sales. So key measures are include gross margin ratio or the operating margin ratios. And the key insight for the gross margin is that the gross margin shows you the production efficiency. So how much did you generate by producing your your service or your products. And the operating margin shows you the overall business efficiency. So higher this margin ratios, the higher the profitability, which is a good signal. And the risk is the most important exam topic. You must distinguish between business risk and financial risk. Business risk is about your cost structure. High fixed cost means that you have high operating leverage, great in booms and deadly in recessions. So the operating leverage is driven by the use of fixed cost. And the leverage is like a double-edged sword. It may good for you in boom condition, but it will be bad in recession period. And this is because a small revenue changes lead to a large profit changes driven by fixed operating cost. So again, small changes in sales lead to a large changes in earnings because of fixed operating cost. And a financial risk is a choice by the CFOs or the CEOs of the firms, and the management chooses to take on debt. This as interest expense, which must be paid regardless of your earnings or sales. So the financial risk is driven by the use of debt. While there is some advantage of using debt, it may increase efficiency of operating business. On the other hand, if you have more debt, it will cause higher interest expense, which result in a higher risk. But importantly, the risk we're saying here is not about something like the default risk. We're talking about the financial leverage here. What is the leverage? As I said right before this slide, it's like a double-edged sword. So financial leverage is the strategy of using borrowed money, debt, to increase the potential return on an investment, or to fund corporate growth, essentially amplifying, increasing both earnings and losses. So by using that, investors and companies can control larger assets. But higher leverage increases financial risk. Say, increase is earning volatility and the potential for significant losses. And of course, it increases the default risk. But the financial leverage refers to the earning volatility. The earnings variance, the amount of change in earnings, the profits become large if you use more debt. So you can earn more profit in good economic condition if you use this financial leverage, but at the same time you can lose more money because you have to pay out in the interest expenses regardless of your earnings. So for operating and financial leverage, refer to our original lecture PPT, and I hope you understand this concept by using those examples provided. So on the exam, you should be able to discuss the concept, and you have to show what is the leverage effect using those examples I provided. That means you have to show by using the case examples why those effects lead to more earning in economic boom status, and why does that may also lead to more losses in economic recession status. So this is the last page I prepared, and let me leave you with the most important point. So the exam tests your understanding. It does not test your memorization. So instead of asking what is the current ratio, you should ask what does a high current ratio imply? What does a high current ratio suggest, indicate? So you have to you have to be able to interpret and discuss those numbers. Of course, to interpret and discuss those numbers, you have to firstly memorize and calculate those ratios. And let me summarize some key themes to focus on. For the efficient market hypothesis, you have to know the differences between the three forms, and you have to know how to test each forms of hypothesis. And the another important part was the implication for the investment strategy and the examples of market anomalies. And for the financial statement analysis, focus on why each ratio matters. You must provide some ratios. You must provide some calculations for typical ratios in each category. Say, what are the typical ratios used to measure a firm's profitability or liquidity and so on? And you have to be able to explain or discuss the trade-off between the use of fixed cost and debts. So always think in this structure. So think about the concept, and think about the mechanism, and think about its implication. So for instance, if there is a high fixed cost, it means that there is a higher operating leverage. That means there is a higher risk. This is because you must explain or discuss or illustrate using your own example. So on the exam, of course, you need to know the calculations, but that's not all. Don't just calculate. You have to ask the interpretations and the implications. So when you study for your exam, keep asking yourself why. So that's it for today. So if you understand the logic behind the concept, I believe you will do very well on the exam. Good luck. So see you after the exam.